They always say follow the money. But what happens when the money seems to be telling two completely different stories at the exact same time? Right now, there's the story you see plastered all over the headlines, this frantic, almost desperate rush into gold. But then there's another story, a much quieter one, that's playing out on institutional trading desks. Today, we're going to pull back the curtain on that second story because it might just be pointing to a massive commodity supercycle set for 2026. And this is really the heart of what we're digging into. While everyday investors are chasing gold as it hits these historic highs, the truly strategic money might be playing a totally different game. It's a move that's not about hedging against the old economy, but about literally cornering the resources needed to build the new one. And look, let's be real. The gold story is compelling for a reason. Gold has been on an absolute tear. It just surged to a new all-time high of nearly $4,400 an ounce. A move that big doesn't just happen quietly. It gets everyone's attention, and it's fueling this mix of panic and, well, FOMO. What we're witnessing is a full-blown mania. This isn't just about numbers on a screen. You can see it right here. People are literally lining up around the block at gold dealers. Google searches for buy gold have just gone parabolic. You can almost feel the euphoria and the urgency in the air. So what's behind all this? Well, it's not just one thing. It's really what you'd call a perfect storm. A whole bunch of global anxieties and big institutional moves, all pointing in the exact same direction. It's really this perfect storm of uncertainty, isn't it? On one side, you've got this rising economic anxiety and geopolitical chaos pushing people towards safety. On the other, you've got trade tensions and serious questions about the long-term stability of the US dollar. But the real kicker, the massive institutional signal you just can't ignore, is that central banks are buying. They are piling into gold at a rate we haven't seen in over 70 years. And that's a powerful signal that something fundamental is shifting under our feet. So with everything going on, running to gold feels like the most logical move in the world, right? It's the classic safe haven. But is the story really that simple? Is gold actually the perfect, bulletproof hedge everyone thinks it is? Well, let's look at both sides of the coin here. The bull case is the one we all know. It's a proven safe haven, it's an inflation hedge, and it's got thousands of years of history behind it. But the bear case is just as strong. Gold can be incredibly volatile. Its long-term returns, kind of mediocre, honestly. And here's the big one. It generates zero cash flow. It's just an inert asset that sits in a vault, and it can actually cost you money to store it safely. And this right here perfectly illustrates that volatility point. It is so easy to get caught up in the excitement of a rally, but history shows us that gold's price is absolutely not a one-way street. Get this. There was a 20-year stretch from the 80s to the 2000s where gold actually lost value against the dollar. And while it definitely spiked during the 2008 and 2020 crises, analysts are pointing out that price moves this sharp have in the past been followed by some punishing drops. We're talking 20 to 33% declines. So much for a stable store of value. Which, of course, brings us to the key question. If the traditional safe haven has some pretty serious flaws, and if the retail crowd is just piling in based on headlines, is there another story we should be paying attention to? And the answer, at least according to some big institutional players, is a resounding yes. See, the real story might not be about hedging against the collapse of the old world. It's about investing in the foundation of the new one. And that is the thesis behind the 2026 Commodity Supercycle. The really strategic pivot here isn't a flight to safety. It's a calculated move into the essential building blocks of our future. We're talking about the raw materials that are absolutely critical for the energy transition and all of high-tech manufacturing. Specifically, we're looking at strategic metals like lithium, cobalt, and nickel.
So why now? Well, just look at the mind-boggling amount of investment projected for 2026. Over $6 trillion in global IT, $2.5 trillion in AI infrastructure. And this isn't just about software. Building the data centers, the servers, the new power grids for this boom, it requires almost unimaginable amounts of energy and highly specialized materials for everything from advanced wiring to semiconductors and high-density power storage.
Probably the most visible driver of all this is the electric vehicle revolution. Global EV sales just crossed a huge threshold, 25% of all new cars sold. And here's what most people don't realize. The sheer density of metals required for each EV battery is a complete game changer. It creates a step change in demand for lithium, cobalt, and nickel compared to a regular gas-powered car.
This isn't about fear. It's a structural demand curve that's tied directly to progress.
So here's the million-dollar question. Where do all these metals come from? This is where geopolitics comes roaring back into the picture. As you can see here, China has built up an incredibly dominant position, not just in mining, but in the refining of these critical minerals. They control 98% of the world's gallium, which is crucial for semiconductors. They're a key refiner for all the big EV metals. This means the trade wars that are going on, they're not just about tariffs on TVs anymore. They are about securing access to the fundamental resources you need to build a 21st century economy. Okay, so that's the big picture. That's the what and the why. A potential supercycle in strategic metals being driven by technology and geopolitics. But how would an investor even start to navigate something like this? Let's walk through a strategic playbook. A really sound strategy here is going to rest on 3 pillars. First, you've got fundamentals, the why. We've already covered this. It's the structural demand from EVs and AI, not just fleeting market fear. Second, you have technicals, the when. This is all about using market data to time your entry and exit. And third, and this is a big one, cash flow, the how. This is where strategic metals are so different from gold. Unlike a bar of metal that just sits there, an ETF that holds mining companies can pay dividends. You can even generate your own income by writing covered calls against your position. You get paid to wait for your thesis to play out. Okay, I really want you to pay attention here because this might be the most important part of the entire playbook. This quote, it just gets to the brutal truth of investing. See, amateurs focus on when to buy. Professionals are absolutely obsessed with when to sell. If you don't have a predefined exit strategy, a price where you take profits or cut your losses, you risk writing an asset all the way down, telling yourself, I can't sell for a loss. But here's the secret. The moment your exit trigger was hit, the money was already gone. A plan for getting out is what separates disciplined strategy from just, well, wishful thinking. And speaking of professional strategy, let's touch on a more advanced concept. If you're looking at commodity ETFs, you absolutely have to understand contango and backwardation. All it really means is comparing today's price to the future's price. If the price for delivery in, say, 3 months is lower than today's price, a state called backwardation, it can be a powerful signal that there's a supply shortage right now and really strong immediate demand. Spotting that shift can help you time your entry so much more effectively. It's a key signal the pros are always watching. So we've laid out 2 very different narratives, haven't we? The fear-driven rush into gold and the growth-driven case for strategic metals. So how should we frame this choice? Is one a hedge and the other a gamble? I think this slide frames it perfectly. These aren't just 2 different assets. They represent 2 fundamentally different bets on where the world is headed. The gold bet is, at its core, a defensive bet against the current system. You're trying to protect yourself from collapse, from chaos, from currency debasement. The strategic metals bet, on the other hand, is a constructive bet on a very specific future. You're investing in the tangible things that will actually build that future: electrification, AI, and the complete rewiring of our global supply chains. And really, that's the question this all boils down to. This isn't just about what you think the markets will do tomorrow or next week. It's about what kind of world you see emerging over the next 5 or 10 years. Are you positioning yourself for a breakdown of the old or for the build-out of the new? The answer to that question is going to tell you a whole lot about where you should be looking.